Hey everyone. Today I wanted to talk about why you should stop looking at the market every day. Right? Now, I'm talking about this obviously because what's going on in the world right now, everyone knows what's happening between the US and Iran, the oil crisis that's happening, markets are going crazy at the moment. And for a lot of people, they get addicted to looking at the market because one, it's fascinating to see what's kind of going on, and they think that there's unique opportunities that can happen. And to be honest, there is some at the moment. But I wanted to really talk about why people need to stop looking at price tickers and the stock market on a daily basis. So, first point I wanted to make is that when you are a individual, so a person who is trying to build their own wealth and their family's wealth over time, you only really have the option of being a long-term investor, if I'm being completely honest, in my view. The reason why I say this is because, and I'll talk about this later on, is that if you are someone that is trying to trade or execute deals on a short-term basis, the chances are is that you are actually going to lose, and I'll explain this a bit later on. But so to be a good long-term investor, you need to actually shift your mindset from being someone that looks at price tickers and feels good when the value of their assets go up and then feel bad when the value of their assets go down, to being someone that believes in the value of a company in the long term. So what is the asset that you're holding, right? What is the value of the actual business? Is it a good business? Does it run well? Because in the long term, those kinds of businesses are the ones that will actually last, right? And not looking at price tickers every day allows you to actually have that mental resolve to be able to buy it and forget it, right? Whereas if you're looking at the market every day, you're emotional. And so in a time like this, when you actually have a crisis happening, if you look at the market every day, instead of being someone who thinks, oh, okay, we have good companies now that are being impacted by short-term circumstances. So that means that there's good companies that I can buy at discount. If you look at the market every day, what you're seeing is your portfolio value decrease in value. And so you're actually thinking, oh shit, I should pull my money out, which is the opposite of what you should be doing. You should actually be looking to buy companies at discount, right? So to do that is, if you're like everyone else, let's say you're someone who works as a salary job or get a regular income, that means that instead of just when your income comes in every month or every fortnight, instead of going out and buying stocks at a discount, what you're doing now is you're looking at it every day and thinking, oh shit, I should short my position or take my money out of the market, right? So it's the opposite effect of what you should be doing. And so earlier on I said why trading or short-term kind of making deals or investing is something that you should not be doing, is because I want to use an analogy to explain this point. So if you were to tell your mates, right, your friends, if I was to tell my friends, that you wanted them to invest in your venture, and your venture is to go out and compete with the top athlete in whatever sport or field you find interesting. So if you were to tell your friend that I want you to invest in my venture, I am going to go and beat Magnus Carlsen in chess. I don't even need to finish where I'm going, right? You guys know that this is a ludicrous idea and that everyone would probably tell you to say, no way, right? A lot of people don't understand, particularly retail traders or your individual mom and dad investors. They don't realize that when they engage in trading, right, on the markets on a short-term basis, they don't understand that they're actually implicitly asking, they're actually doing this, right? They don't realize they're actually trying to compete with elite athletes, right? And in this scenario, the elite athletes are institutions, right? So you have capital firms, right, like the top tier firms in Wall Street, right? And the best way to understand how they operate is to make an analogy towards, let's say, an energy company. So my background is in energy, right? And the way that energy companies run, particularly, is through the ownership of assets, right? And I'll spare you all of the details, but essentially, if you imagine a power plant, right, that has what's called a SCADA system. A SCADA system is supervisory control and data acquisition. They are essentially bots or robots that acquire vast amount of data, operational data of how the power plant works, and assists in the automation of particular functions and processes, right? So if, say, the plant is operating outside of its normal operating envelope, then a SCADA system will automate the resolution to bring the plant, by altering its performance, to come back into a safe envelope. And people don't realize that capital funds work in this same way, but they do this on capital, right? So they will essentially have a automatic process that allocates capital and then pulls capital out based on risk measurements. And for an energy company, they pay about $1 million a year, right? Subscription costs or whatever, to be able to access this feature. And they also have teams of thousands of people doing research as well, right? And they all work to the same beat of a system, right? As an individual person, when you trade, no matter what guru on YouTube tells you, you will always be emotional, right? And you will always be less likely to have those processes and systems, typically because you just don't have access to them, right? And when you trade in the market, you're essentially saying that you are going to try to compete with those institutions who exist in the market, right? And if you look at the statistics, and now, brokerage firms, they're starting to have to say this, is that they actually have to say that 70 to 80% of people who try to retail trade lose money, right? So that is, statistically, it's against you, and it's because of these institutions. The other thing that I wanted to talk about is that these institutions also have access to data on retail traders, right? So they have access to volume data, time price data as well. So they can tell, okay, on a particular asset, what is the buy or sell volume of this asset from non-institutional players. So institutions now, they're actually playing a game against you because they see your buying activity, right? And so they can take the other side of the trade. So if you have a bunch of, a large amount of activity in retail traders buying a particular asset, institutions can wait till the value of that asset increases and then just short their own position, because now there's liquidity in the market which they can take. So these are just a couple of thoughts on, again, as to why I think people need to stop looking at the stock market every day and switch to a long-term focused value investing mindset, and to essentially ignore all the noise that you see on the news, that it really is just there to get an emotional response out of you. Thanks.